So we move into Chapter 7, IAS 37, Provisions, Contingent Liabilities and Contingent Assets. Remember what I said about standards, and in this particular one, certainly it's relevant, definitions, conditions or criteria, accounting treatment and disclosure. First area for us is provisions. So it sounds to me, when we use the word provision, we're talking about providing for something. What are we providing for? Well, a liability. A provision is a liability of uncertain timing or amount. It's a liability that we've decided we need to create because we haven't reflected it within our accounts. So I guess we would use a journal entry to bring it into the accounts, but it may be uncertain, so we have to be careful. We may not be sure of timing or indeed amount. Outside of that, what we should understand is this liability is a present obligation arising from past events. So for example, you may have present obligations in the form of perhaps some sort of loan that you've taken out or a hire purchase agreement. That's an obligation relating to a past event. Now note second part of the sentence, the settlement of which is expected to result in an outflow of economic resources. What does that mean? Let's put it into basic language. We're talking about a payment. So there's a present obligation that arises from past event that's going to result in a future payment. Therefore, we need to reflect this liability by providing for it, by journaling it in to our accounts. What about an example? I've taken this, as you'll see, directly from the study hub. We have an individual called Sheriff. He gives warranties on the computers he sells. If the product's faulty, the customer can return it. Therefore, Sheriff has to make a provision as he may need to refund the customer their money. There is a possibility that a given computer will be faulty. So all he is doing is sort of guarding against that by making a provision of some kind within his accounts, possibly for a considerable amount, possibly for a proportion, or indeed a percentage. So in terms of provisions, first off, let's just say that what we're trying to do is to create a liability in relation to an obligation that may well come true in the future. Now, in terms of recognition criteria, again, for criteria, read conditions. Remember, let's memorize them. For any liability, including provisions, to be recognized, all three of the following have to be in play. Remember, all three. So it has to be a present obligation, an obligation now, legal or constructive. And what we mean by that is legal in the sense that it's bound by some sort of formal commercial contract, or constructive, perhaps based on somebody's actions. Somebody has done has created an obligation. It exists due to a past event. In other words, it hasn't just cropped up just now. It exists due to a past obligating event. That's the first condition. The second condition, or indeed criteria, if you will, an outflow of resources to settle the obligation is, note, probable. Let's stop there. What do we mean by probable? We mean a 50% chance or more, not less than 50%. It has to be probable. Outflow, we simply mean a payment. So a payment is probable. The third area for us is a reliable, note, a reliable estimate of the obligation can be made. Let's just say that your lawyer comes to you and says, well, in relation to this particular case, I think it's very probable we're going to lose. But to be honest, it could be anywhere between 100,000 and 3 million. That's not a reliable estimate. If we can't make a reliable estimate, then how can we provide? We can't use complete and utter guesswork. Reliability is important. This is a set of financial statements, after all, that people, users, stakeholders will rely upon. So let's remember all three criteria in play. Okay? Now, let's move on to our next area, which is measurement. And this goes back to my point about sort of reliability. What is a best estimate? Well, a best estimate is really our information, or the information that we have based on information that we've gathered, that we think, well, we're reasonably certain that this amount is a good amount. This is our best estimate. What might that best estimate be? Where might it come from? Well, a couple of examples. It might well be that we've come across some form of evidence that provides us with that evidence. Perhaps someone else, it could be a lawyer, it could be a lawyer for the other side, it could be some sort of other event in some way, shape or form that provides us with information. Or maybe a midpoint in a possible range of values. Let's just say that the lawyer that we're using comes back and says, well, very probable we're going to lose this case. It's going to be somewhere between 800,000 and 1 million. Let's take 900,000. That seems to be a good estimate. Outside of that, maybe the most likely outcome for a single or one-off obligation. Perhaps there's a precedent. Perhaps we're familiar with other cases or other claims against similar companies that are in the same sort of area, and we think that certainly, our claim or our likely future obligation is going to be in that area. Okay. Our next area is really sort of accounting treatment. You remember from our study of standards, accounting treatment is really our third area outside of definitions, criteria or conditions, and indeed disclosure being fourth. So accounting treatment, we must recognize provisions in the financial statements when all the recognition criteria have been met. Okay, when we say recognize, we must journal them in. I must make a journal in my accounts to adjust these financial statements. What are the steps that we would use? Now, I refer you back to accounts receivable and payable, or indeed receivables and payables, the chapter, I believe chapter 6, where we did something similar, where we looked at provisions at the start of the year and indeed the end of the year and looked at the difference. So our starting point for calculating a provision right just now is to calculate the closing provision. So what's our estimate of the provision as at the balance year end right now? Okay, once we've done that, let's just say, okay, well, what's the difference between the provision now, closing provision, and what the opening provision was? You'll recall from receivables and payables chapter that really what we were looking at was the allowance for receivables, where we're looking to provide against, let's say, the possibility of some debts, maybe general debts, 5% going bad. So we're looking at the difference, or we looked at the difference between the opening balance, start of the year, and the closing balance, and we figured that really the difference is going to be either an increase or a decrease. Now, depending upon whether or not it's an increase or a decrease, we adjust through the provisions ledger account to reflect the closing provision amount. So as we journal in either an increase or a decrease, really as follows. So we've calculated the current provision. We see, let's say, scenario 1, that the current closing provision is more than it was at the beginning of the year. What do? Well, let's look and think back at our double entry rule. Our double entry rule says that if you are trying to increase a provision, because remember it's more, I am trying to increase a liability, I credit the liability or credit the provision, and I debit the expense. For argument's sake, let's just say that it's electricity, or it could be allowance for receivables. The journal entry is very, very clear. Increase the expense by debiting it, and increase the liability by crediting it. That's our double entry rule. What about the reverse? What about if the provision currently, the closing balance on the provision account is less? What do we do then? Well, really the reverse. I want to reduce a liability. Going to my double entry rule, to reduce a liability, I debit the liability or debit the provision account. That reduces it. To reduce an expense, I credit the expense as per my rule. So again, if this is not making 100% sense, good idea, go back into this particular chapter, or indeed the allowance for receivables area under the receivables banner of provisions for irrecoverable debts. That would be a good one to look at as well, because it's exactly the same as I've just described. Okay? Let's now look at our next section, contingencies. So this is, I guess, our sort of second main area. What do we mean by a contingency? So key issues really as follows. A contingency could be an asset or a liability that is sort of contingent because of uncertain future events that may or may not occur, or possibly the idea, I'll just go back, that recognition criteria have not been met. In other words, recognition criteria of the above present obligation, future economic benefit, reliable estimate, etc., etc. You'll recall we went through that above. So on that basis, it's sort of contingent. There's a little bit of uncertainty there. It could be an asset, in other words, positive, or it could be a liability. So in terms of the possible range of outcomes to express the uncertainty of a contingency, first off, possible, quantified probabilities, maybe a 40% chance of A or a 60% chance of B or specific. So remember that cutoff point of 50%. Outside of that, in terms of general descriptions, certainly, using information such as, I'm talking about the examiner, for example, probable or remote, that gives us an idea of the level of uncertainty. If the examiner says absolutely remote, we know it's completely unlikely. If he says probable, it's more than 50%. Now, in terms of sort of how we deal with these areas, let's look specifically at contingent liabilities first. Let's look at our key definitions. First of all, it's a possible obligation, note possible, arising from past events whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Okay, so there's our first possibility. Notice the word possible. Okay, what about the other side? There's a slightly different definition. A present obligation arising from past events not recognized because outflow resources is not probable. In other words, let's say it's possible, or it can't be measured. So this is a reference back up to the criteria up top for recognizing provisions. Well, it's not probable and it can't be measured. Okay, so to open this up a little bit, what about a couple of examples? So let's look at example one again for Sheriff. He's a busy boy. Sheriff is the guarantor of an overdraft for another business. The likelihood of a liability arising under guarantee is assessed as possible, so less than 50%. This is a contingent liability, and Sheriff may have to pay on behalf of the other business, not will have to pay, may, less than 50%, only possible. That is a contingent liability. It's contingent upon the business doing well, honoring their debts, etc., etc. What about the second example? So, in this case, Sheriff has been taken to court by a customer who claims they slipped and fell on his premises and suffered a personal injury. So, court case ongoing. The lawyer, note, believe that Sheriff may lose the case, but it is impossible to estimate the potential damages. We can't estimate. Remember our criteria. Sheriff has to disclose a contingent liability in respect of the court case. Make a disclosure. and we'll see as we go across the page, disclosure, really detail as much information as you can in relation to this contingent liability. What about accounting treatment, given what we've said so far? Let's take a look at this. So what we're saying here is that these contingent liabilities should not actually be recognized as liabilities. They will be disclosed unless the possibility is remote in the notes of the accounts. So broadly speaking, contingent liabilities disclose. Remote means, in essence, highly unlikely, less than a 5% chance. Okay? So that's liabilities. What about the flip side of this, I guess, in one sense, which is assets? So this is positive. I mean, in one sense, I guess we do like contingent assets because it could be something coming in. What's the definition? Well, it's a possible asset arising from past events whose existence will only be confirmed by the occurrence or non-occurrence of one or more certain future events not wholly within the entity's control. So exactly the same as up top, except asset. What about examples of this? Now again, we have two. So first things first. So Sheriff had to write off computers held as inventory due to a fire in the warehouse. So that write-off has been done. He has claimed on the insurance but has not heard if he was covered for such losses. This is a contingent asset because he may receive some insurance monies. What about the second example? Well, he's decided to take a builder to court. They've failed to complete work during his premises. This delay has led to a loss of earnings for the business. The lawyers think that it is likely, note likely, the sheriff will win the case. He can therefore disclose a contingent asset, note likely or probable. So therefore, let's make a disclosure. What about accounting treatment linked to what we've just said? Well, the first thing is that the existence should be disclosed if it's probable or likely that a gain will be realized. The disclosure must avoid giving misleading implications about the likelihood of realization. So you have to be very, very clear on the specifics. You can't say, we are definitely going to receive £1 million in 3 weeks' time. Okay? Basically, take legal advice. Outside of that, point number 2. When the realization is virtually inevitable, there is no condition and contingency, and recognition is appropriate. Now, virtually inevitable, we're talking about just about certain, more than 95%. I think the chances of something like this appearing in the FA exam is probably unlikely, remote if you will. Okay, I think they're more likely to put you in a position where you're dealing with contingent liabilities more often than not, where it's possible versus probable, etc. But nonetheless, there's the detail in relation to a contingent asset. Third key point, they should not be recognized as assets because this may result in recognition of revenue, which may never be realized. Okay, so subject to point 2, i.e. inevitable, they certainly should not be recognized as assets. Okay? Let's move across now to scope and what we mean by scope. And this is important because I've seen the FA examiner include questions on point number 1 here just alone. And this is some easy marks. How far does IAS 37 spread? Who is it applicable to? It applies to all entities according to the standard. Now, the examiner, I've seen him include questions that say IAS 37 applies to, let's say, only limited companies or only private limited companies or all businesses or, only listed companies. It applies to all entities, okay? And it details what we know: accounting treatment, provisions, liabilities, contingent assets, excluding those covered by other standards. That's not overly relevant to us. The key point is all entities, okay? Now, in terms of these situations or event, all lacks certainty, okay, about when the events will occur and the value placed them. So timings and indeed measurement or value. So this is what affects the way that they're reported. We're just not sure. We're not sure about things, and we can't go providing for items that we think, well, it might happen, it might not. These are accounts, financial statements as mentioned, and people rely on accounts we need to be as accurate as possible. We can't be sort of willy-nilly and hope for the best, okay? People rely on accurate information. Now, disclosure requirements in this area, again, you know what I think about disclosure. It's more a question of, well, what do we not include in this area of disclosure for IAS 37? So for provisions, you'll see really just about everything. A description, any detail that we have on uncertainties or assumptions about timing or amount. Maybe there's an expected reimbursement, i.e. maybe we actually expect something to come back, not just that we're going to be paying out in the future for this item that we provided. Maybe there will be some sort of receipt. Let's disclose it. And a detailed breakdown of the movement in the provision. We went through the provision account and how we sort of come up with our closing provision, more or less, etc. But let's actually disclose opening and closing, addition, amounts used, any reversals, etc. So that's provisions, just about everything. In terms of contingencies, again, what you'd expect. What's the nature of this contingent liability or asset? Can we estimate the financial effect? If not, so be it. What uncertainties affect the amount or the timing? So that's just about everything relating to either a contingent asset or a contingent liability. This next little table is quite handy, although I think it's a little bit of overkill for the FA exam, but good nonetheless. It really summarizes the disclosure requirements and indeed the accounting treatment for these various possibilities. Now, would I suggest that you go as far as to literally rote learn or memorize this right now? I don't think so, because I think that if we focus in on my four main areas, definitions, excuse me, conditions or criteria, accounting treatment, and basic disclosure. Let's focus in right now just on the basics, and let's learn the balance of the information up and above over a pass mark from doing the questions. This is quite a lot of information to learn right now. You might get confused. If you just understand that at this point, just basic definitions and basic treatment, I think we're good to go. Okay, so that concludes this chapter, IAS 37, provisions, contingent liabilities and assets. I don't think this was too bad. I think this was fairly reasonable. I think most of the standard chapters, the chapters that relate to accounting standards, are fairly reasonable because the depth to which the FA examiner goes into is not extreme. This video, this mind map that I've just taken you through is not the be-all and end-all of IAS 37. It's probably around about 50% of it, maybe a little bit more. So nothing to worry about for us. Let's stick to the basics. Let's keep putting one foot in front of the other in terms of our learning, and let's move towards success. Little by little is the key. Okay? I hope you found that useful and that your studies are going well.